Welcome back, everyone, to another episode of the EUVC Podcast. Today, we're diving into a topic that's sparking intense debate in our community: quantitative venture capital. What happens when data, AI, and probabilistic reasoning meets the art of early stage investing? And how will this reshape the craft and the careers of VCs across Europe? To unpack that, we're joined by the team at Rule 30, an AI research lab building the world's first fully systematic venture strategy. I have to say, today we're not just going to talk about Rule 30 because it is an incredibly important topic that everyone has a perspective on. So for that reason, we'll dive into, of course, the very interesting model behind Rule 30 and how you work as a VC. But of course, we're also going to dive into the broader topic.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
From first time to seasoned investors, the EUVC syndicate is not just about capital. Get involved, co-lead deals, share insights, bring in great people, and help shape the pipeline with us. Visit eu.vc/syndicate to learn more.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
And let's start on the broader topic. But before we go there, to both of you, say hi to everyone, say who you are.
Hi guys, I'm Damian. I'm one of the founders of Rule 30, and my focus is mainly on the technology side and obviously on the fundraising too. My background, I'm a mathematician. I'm from Romania originally, moved to London about 15 years ago. And about 9 years ago, Guy and I set up a venture builder together. That's how we met. And yeah, through that, we stumbled across the problem. Raising capital for the companies in the venture builder made us think that the way VCs, especially at the early stage, take decision is pretty random. So we looked a bit deeper into how we can systematize this, and this is how Rule 30 was born.
Well, that's a frustration every founder knows.
Yeah, hi, I'm Guy, the founder at Rule 30. Yeah, background in kind of engineering education, then some work in management consulting and private equity. Got introduced to Damian 8 years ago now. Started up a venture builder, so the work he was doing was far more exciting and inspiring than my days spent in tabs of spreadsheets. Yeah, and we've worked together for the last 8 years. As Damian said, it was the experience with the venture builder that gave us the insight into venture capital. Yeah, what we could see is that everyone was talking about how startups operate on this power law distribution. Not many people were talking about how venture capital funds operate on that same power law distribution. And what we could see from the successful funds, that very few of them could be successful 2 times in a row, and almost nobody, maybe Benchmark, maybe Sequoia, but almost nobody can be successful 3 times in a row. So the excitement around what you could do with a systematic strategy to more consistently hit those returns was too much to turn away. And we ended up pivoting the business back in end of 2020, and it's been Rule 30 ever since.
Yeah. And it's, of course, the dirty little secret of venture, which most GPs do not like saying to LPs, which is that VCs very much, as you said, operate on a power law. It's not just the founders, it's unfortunately also the venture firms. There are many reasons for that we can dive into. Today, we'll probably only dive into it from the decision-making perspective, from the smart use of data perspective. I think there are other systematic drivers of it as well, but let's not dive into that now. Let me open this conversation up with the very first question of how you think we best define quantitative venture capital. And then from that, you can go into talking about Rule 30 versus traditional VCs.
If you think of venture capital, there are a few elements that can be used as levers for firms to basically do better investments and manage DPI. But if you look across that, so you definitely have the sourcing part, you have the decision part, so what you invest in, and then you have the portfolio construction part and the big areas. And obviously later down the stage is the support that you give to founders. On our side, and how we are looking at it, a true quantitative venture capital needs to have solutions for every decision across the first part and up until selection. So starting with the portfolio strategy that has to be packed. So the portfolio strategy has to be packed to your advantages and your operational capacity and what you bring to the table. The decision-making per se is the most important, because even though there's an obsession in venture capital with access, like with discovery, the reality is it plays quite differently than people actually assume. Because if you step back, in theory, and the easiest example to give is for a later stage fund, for a Series A fund. So in theory, no Series A fund has any form of discovery problem. There's tens of thousands of seed stage companies that have publicly available data that they could go for. The problem comes at the point of being able to actually analyze the data and know what to focus on, right? And that part is very, very important. How you analyze, how you take a very big list of companies to a very small one that you can actually focus on. And once you are able to focus on, how you take decisions on what you invest in, and then further down how you balance your portfolio. So it's the entire decision stack across those parts.
Here you said that the Series A funds should not have a discovery problem. Would you also say that that is true on the earlier stage, or is quantitative VC only relevant at this point at Series A onwards?
No, it's for everyone else. I mean, it's more a VC type of problem, and I think that the focus on what people spend their time on actually and spend their intelligence on. If you look at pre-seed, you have quite a host of tools that appeared in the last couple of years, in the last few years on the market, like Harmonic, for example, that basically collect or have suites of scrapers that collect founder signals. Now, these founder signals are basically generating new lists. Almost think about a Crunchbase 2.0, basically. These new lists, and this can be quite exhaustive. So on our side, we get in the hundreds of these new, like our scraper bring hundreds of new signals every week. But then the problem comes, if you have a small team, what do you focus on out of those hundreds? And the only things people resort to are pedigree heuristics, what the founder basically was doing before, or who knows them in their ecosystem. But that gets people to actually not focus and not be able to analyze the entire ecosystem. So our power and the power of Quant VC is actually not only being able to pull the data in, which is fairly trivial on the scraping side, but then is that ability from pulling of hundreds of signals to triage down to a list that has a distribution of winners to losers that's a lot bigger than the basically random VC space.
Probably an important point to make here, the important differentiation is between, maybe we're going to come to this later, but between Quant VC and data-driven VC. We see a lot of funds talking about data-driven VC, especially in the last 3 or 4 years. There's been this movement of data-driven VCs. It's in the way we look at it that it's almost hygiene, right? What they're doing in terms of using the available data points to inform better decisions. The challenge that we have with data-driven VC is that it's not a decision engine. Okay, so it's helping to see more startups or to make better decisions. But if it's not a decision engine, and then you rely on the same IC processes where the IC decides what they want to do, they'll use the data where it agrees with the culture or the push in the room, and they won't use the data where it doesn't. And so, yeah, for us, it's trying to distinguish that Quant VC is we rely on our algorithms to inform, to make our decisions. We're not just using data points that we can sort of find available.
Then let's talk about the elephant in the room, what you've been describing here, that you actually use the data to make the decisions, that you have a decision engine that's driven by AI. Let's unpack that, because I think we all understand, we all know the harmonic platforms today, I think, and the likes of that. And I think that where many would challenge you and someone doing what you're doing is, can you really go further than just making sure that you see the right things? Can you really go to the decision point?
So yeah, I think that's a very, very common question, as you can know. And then people make this assumption, this automatic assumption that there is not enough data to predict at pre-seed stage. Well, I think the correct phrase there, or the correct truth, is there is not enough data that can be humanly computed that leads to that. And to give you an example, let's say you're investing in deep tech companies and you have 2 companies that come and present you, but quite nascent technology to solve a big problem. And each of them very good researchers from good universities and look at the problem differently. As a human, yes, you could do some due diligence in terms of asking research peers for an opinion for that solution. But the piece of data that exists that the proper quant model can use is like taking all the white papers in the world, building attribution model behind all the researchers, figuring out the researchers point to this problem, and from that get quite a rich feature set that you can feed into a machine learning. There's just one. It's a lot more others in terms of how you analyze founders in compared to cohorts and baselines from where they started in time series ways. So we can get quite geeky here, depending how much you want to dive into it. But there's a whole huge host of data that is not easily computable by humans that algorithms can take into account. It's just very, very hard to build the data layer and to create it. But we've been doing that for the last 5 years. So we know for sure there is more than enough data.
I think we should be super geeky, because if we think of our three constituents as audience, we have the VCs to whom this might be incredibly disruptive. We have the founders who are about to be evaluated by computers instead of people. And then we have LPs that are trying to figure out, am I in a dead asset class?
Okay, so let's then unpack exactly what the decision means, right? If you look at other funds and if you look at the power law, and everyone in VC kind of talks about the power law, but I don't think many fully understand what it means. But what it drives, if you look in the end, you have a universe of companies that are raising capital. That's the universe that you can go for. Any form of selection process, regardless if it's human-driven or if it's machine-driven, regardless if it's based on childhood trauma and of deep understanding of markets or a mix of it, is in essence a filter on the distribution that you're looking at. So you're saying, the easiest example to say, saying I only invest in repeat founders conceptually. That's the easiest filter to conceptualize. Once you take all the founders, all the companies that you could potentially go for and analyze, you apply this filter with repeat founders, all you're left is with a sub-distribution, and you hope there's a better DPI there. Once you have that sub-distribution in the actual VC decision-making, even for funds, like a normal fund will have roughly 2.5 of their investments that will drive roughly 80% of their debt returns. And that's the action of the power law. Even in brilliant funds, like even if you look at funds like Benchmark, for example, that stat will be roughly 4.5% driving 70 of the returns. So thinking on these success metrics, you're basically understanding that everyone is filtering a distribution and then kind of picking at random from that sub-distribution. That's literally what happens for every form of system, regardless if quant or not. Now on our side, and the way the system was trained, it was trained by tens of thousands of companies from the past in terms of objective data. So it has no opinion, it has no weights, it's no statistical model in that sense. It's a model that took every yearly cohort from 2010 up until as close as possible we can get to today. Then you have other algorithms and math functions that aim to figure out which one was the top 10% of the distribution in terms of the delta in valuation from the first round. Those ones, those 10% are basically trained. The model is trained on understanding what makes those 10% winners. The other ones are defined as losers. So it's not about picking unicorns at all. It's about maximizing the DPI at the distribution level in terms of the way you can pick. So we tested it, like since we ended up having a product that we can test, which was roughly a year and a half ago. We ran it against many the portfolios, and we backtested it against the portfolios of many investors, and absolutely all the data shows so far that we're beating that capacity to filter a better distribution by many times that the maximum human can achieve. What it also unlocks the capacity to actually look at scaled distribution, because that was I was intuiting at the beginning, right? So if you have a fund that has 3 analysts, even if the data exists, even if you bring to any form of tools, any form of data, if you bring 100 companies per month in your pipeline, you almost don't have time to fully analyze them, right? On our side, and a Quant VC can actually bring 10,000 companies if they are and analyze them deeply. So you're already starting with a much richer capacity to analyze bigger distributions, so you can be that can go downstream in terms of how good you triage from the total available companies.
Can I ask you about, because obviously the data set that you're able to triage on and filter on the back of is everything. And it's both in terms of the training set that you've used, and it's in terms of the available data for the founders that you're looking at. Many would say that picking a founder, you need to engage with that individual founder to uncover important traits, dynamics in the team, so on and so forth, which means that you can't do it on the back of a deck and you can't do it purely on the back of public data. So what type of process is needed to run with startups and founders to be able to get to a point where your triaging model works? Do you have to meet them first and get that first data point from how they act in a meeting, how they interact in a due diligence process, all that stuff? Or can you do it all on the back of what's available publicly?
Look, not really. This is again a function of the way the human mind and the way the VC works. Like when you don't have any form of data as a human to go for, because your brain is not set up to compute the data that you can get from a deck, then you have to rely on intuition, right? Or like the intuition, how you perceive the founders and all these questions. Now, in essence, I think that's a brilliant data source. Like it's like if you can decode, it's a brilliant data source. But there's also a huge assumption on every VC in the world that there are very good, well-trained psychologists that can actually compute that data, right? And the reality doesn't show it. In the end, regardless if they have this process, and everyone says that, if you look at the fund performance or what they're driving, it doesn't correlate. So in the end, it goes back to something very, very simple. You can analyze in your way. There's many ways of doing venture and many ways of taking any form of decision.
We love the story of the early quant hedge funds. We may have sort of spoke about this before, but people used to analyze companies using, I don't know, their P&L data, right, their balance sheet data. Some of the quant hedge funds, right, they figured out that if they were looking at Walmart for a stock, for example, right, they could take satellite images of the car parks of Walmart. They could overlay some weather data to understand if those car parks were full or not in relation to the weather, and then that was a great predictor of what the sales were gonna be for the stores. So you go from these trailing edge indicators, these very forward-looking indicators, and it's the same as we look at it. That historically, people have always told us in venture that it's a boutique industry, it's an artisan trade. You have to meet a founder, you have to shake their hand, you have to look them in the eye, and that's how you get to good decisions. And you see in the stats, right, is everyone talks about you can see the performance of funds isn't there. So we're not saying that the traditional ways of doing venture are wrong. There's some funds that do it very well. We're just saying that the advancement in technology and the advancement in data availability over the past 10 years has created this opportunity for new strategies to emerge. And from what we see from the LP conversations we have, they're crying out for new ideas to tackle venture, because people know it's a rich asset class, right? People see the returns that you can make if you can get it right.
What is the corollary to taking satellite photos of Walmart car parks in venture then?
I think it's very hard to answer, because simply, especially at pre-seed, you can't have linear models or decision tree based model based on static variables. So it's quite hard to answer a question. It's a combination of many things. But to give you an example here, what I was saying, personality is not a thing. Like any other thing, nothing sits in a vacuum. So the personality will permeate to every decision that the founders make, to the way they communicate, to the way they attack their business. So for example, one feature which holds quite a lot of that personality, the personality proxy, is basically studying the evolution of a founder in terms of the progression through life, both from a professional sense and a network type of sense, in a time series way. And if you study that and take each founder and compare them to similar cohorts of founders within the same geography, they started with the same age, started from the same baseline. And studying those slopes of those evolutions across the graph and the experiences they've done, you're going to see that some founders have outlier trajectory, like, for example, reach certain statuses or reach certain heights, followed by lows or more heights within age frames that others didn't get. That's a feature that takes a lot of the personality.
And this goes to show that it's what you're looking at here are scrapers or data sources that are far beyond, did this person change their LinkedIn status to stealth mode?
Look, exactly as I said, that's the part of actually getting data in. That's trivial. Like many people think when they talk about Quant VC, they think it's a scraper of LinkedIn sourcing. Well, that's basically now it's almost a hygiene. Then the decision is the part.
2 years building our data sets before we ran models. And interesting, what we found when we started to dive into this problem was the data, the source data sets, like, the PitchBooks, the Crunchbase, the usual suspects, right? They're not enough on their own to drive the predictability that we wanted. That the data sets required huge amounts of cleaning, contextualization, work, new pipelines. And what we found, one of the kind of the discoveries in the early stages was that it was painful work, right? It was arduous, painful work that took many years. And we realized that no academic is going to solve this problem because no one wants to spend 2 years of a 3-year, 4-year PhD just cleaning data sources.
And when did academics last solve the problem?
And then no VC is going to solve this problem because, again, the work is so painstaking that they're not incentivized to do it. And it's not work you can just hand over to a junior. It's not work you can outsource. It's not work you can pay someone to do it. It required the deep subject matter knowledge that we had picked up in the years running our venture building.
Can you share some of while you say that it is hygienic to get the right data and so on, I think it could be interesting if you could just share some of the most surprising or shocking or important data sets that you're using, that you're pulling, where people would be like, I had not expected that.
Yeah, look, again, it's not in the data, the raw data comes from 14, 15 different sources. Like obviously you have data from the startup providers, which actually helps you do the label. You have web search data. You have we have a scraper infrastructure that goes across 6 million websites to find signals to bid market competitors and so on. That part, basically, it's almost in its raw form. It's fairly useless by itself. Like the transformation and to build a data layer, we run 14 other models in between. So when the data sources come in, that's a first data pipeline reconciliation, because many sources will contradict itself. So you need to kind of establish your ground truth of what you believe. Once that is done, the hardest part is across the enrichment of the data layer and structuring the features in a way that make relevance to the model. And most of the features, especially because it's pre-seed, they have to be quite composite type of features. The one that I explained to you before is one that's very important. So for mapping out someone's trajectory, so founder's trajectory of work, you need to figure out a lot of things. Like obviously the easy stuff to figure out for each experience that they had in the past. For example, obviously you need to figure out what they were doing. So if they were, I don't know, doing data science or podcasting or how they're going about it. But when the problem comes in is even like conceptualizing a quality of a company that impacts like the company that they work for. We kind of intuitively know that it impacts what they did. So it's a big difference if you work at a shawarma shop down the corner or if you work at OpenAI, right? But then there is more complication because not everyone is the same. Then you need also to end up having functions that actually can compare, I don't know, Morgan Stanley with a Series A startup from Poland, randomly, for example. For that, we use graph databases, which get into a lot of complications on how you set your graph, what type of algorithms you use to actually understand the weights in the graph. So you have all these multi-variables that you have to stitch together, which makes it painstakingly hard because you can have your assumptions in the beginning, but the way you can massage your variables is almost infinite. So it's a lot of trial and error and more intuition building. And you end up, or what we ended up is with a feature set that is very counterintuitive from a human perspective, simply because the algos think different and the available data that you can get is much richer than the classic human understanding on how big the TAM is and how good the smile, how nice the founder smiles. Basically, you have to dig a lot deeper than that.
Yeah. Now let me go to another question, which is a bit about Rule 30 then. And it's that if someone goes to your website, they'll see that you're using the word AI research lab about yourselves, not welcome to the next gen VC something something. Tell me about that decision. What does that mean? What does that imply?
Look, our ambition is not to build a fund and have a nice life in that sense. We're not chasing the VC life. What we think is that the VC space is the hedge fund moment of the 80s and 90s. And basically the ambition is to build a renaissance capital for the private market. We started with VC once because we knew the ecosystem, but also because it's by far the hardest technical problem that you can solve. So building models at pre-seed is, according to GPT, because I don't want to have my opinion here, between 50x and 100x harder than building them at Series B. But by conquering VC, by conquering pre-seed in VC, building upstage model becomes fairly trivial because you would have had gone through that initial data structuring and layering and so on. And it feels like the best beachhead to start from. It's also access to these companies is a lot different than in later stages. At Series B, it's humanly obvious, a lot more competition. The idea is unlocking what we unlocked in pre-seed allows us to go upstream and basically build models and strategies across multiple asset classes in the private market.
So the future of Rule 30 is as an asset manager. It's not as a system that powers the decision-making of A16 set and the like.
I mean, we don't sell alpha, Andreas. It's like we had a lot of push and we had to beg and steal to survive all these years because obviously no VC actually wanted to give us some proper financing, even though when you do the testing with them, they mostly get completely flabbergasted and some of them disappear for a few weeks and then they come back and want access to the algo, but without but that kind of we always resist. We're not a SaaS business. We're sure we built alpha and it's all about using the technology to mine that alpha. It might be that we're going to use it in strategic partnerships. We will potentially power also LPs with our technologies, but in no way, shape, or form we're going to power other VCs.
Maybe just talk about the defensible edge of, because that's one of the things that we often talk about when we talk about this datafication, quantification of venture is then, well, will we have an actual edge? Will any firms have that, or does it all just become a set of very large asset managers that deploy on the back of models?
Yeah, I think the way that we see venture evolving in the next decade is there will be the emergence of firms and funds like ours who build decision engines, who find signal or patterns that can push that decision faster, and will find ways of putting money into companies at a quicker and quicker stage in an earlier and early stage. It's in the way that we also see it is that hedge funds will realize what we've realized, and they have the skills and the experience to sort of enter the space. And in the past we've seen them trying to enter funds like Tiger wanted to do venture. It didn't pan out exactly as they thought, but people know that the returns that can be made in the asset class and have trying to figure out ways to do it. Then I think what we'll find on the other side is the the solo GP, the emerging GP, the groups who have the really deep rooted networks that don't rely on the data platforms or the signal providers to find deals, and are able to quietly go about finding those companies because they come through very trusted sources within their networks. And what you'll end up finding is that the deals that will happen will be the combination that the quant funds will come in and with the money quickly, and the more sort of network driven VCs will partner up with them and deploy capital that way.
I just remembered that I wanted to ask you, because you said before that in your model, and maybe I heard it incorrectly, but you said that what you really optimize for is the delta between the initial round that you would come into and the follow-on round. Did I hear that correctly, or was that wrong?
No, basically, when you create a label to teach me, and this is a very, very hard problem. Like if I would say, look at the past and decide what you would have wanted to invest in, right? And that's basically when you build this binary classifier, which our decision engine is basically saying, what is the success class? What should I learn from that is good, and what should I learn from that is bad? That's a very tricky problem in venture because, because this huge timeline. So to actually look at the single decision and be 100% sure that you want your algorithm to pick that, theoretically you would have to wait 10, 12 years. And a good example is Builder AI, almost conceptually. Would you train your pre-seed algorithm to pick Builder AI or not? In that sense, right? And because you have these long waiting periods, you have to find solutions to create labels to train your model on recent companies. What we saw after a few years from the first funding round, for almost 5 years from the first funding round, at the portfolio level, so not at the singular decision level, there is a very high correlation between the outcomes that happen at the general portfolio level between those 5 years period and 12-year period, right? And then you use that 5-year period to build evidence, basically to build evidence that, look, from this vintage over 5 years, top 10%, right? To allow yourself to build a label closer to home. So basically, in essence, you're trying to shorten the time period in which you can create a label data set, but you still have to keep it correlated with the final outcome at the portfolio level.
Yeah, of course. Okay, I just wanted to double click on that.
Yeah, it's
in more
not.
detail.
No, it's not about follow-ons. You kind of need to you need to predict at the level of the outcome, almost becomes asymptotic with
There's a saying in venture which is that the best predictor of future success of a startup is who leads the follow-on round. So basically, if you have one of the very successful firms, that is actually the best predictor of what will happen to the portfolio company in the future. Is that true based on what you found?
Look, if you look at Series B startups, because this saying comes from Series B startup, and Series B, imagine you're a football scout. Series B is literally the equivalent of scouting 14, 15-year-old kids if they play football. So in that sense, if they play for Real Madrid and Barcelona already, they're probably better, right? So the top K will play for the top teams by that stage. So in that sense, it's true. Like for Series B model, this is not the only single predictor, it's two joint predictors, because we don't operate series models at this stage, but obviously we looked quite deep into it. There's two main predictors there. The quality of your previous investors, for sure, because those investors had time to check the rounds and if they build up. And also the speed of capital accumulation. So basically the distance between round and how quick you get there. But yes, based on these single two things, you can probably outperform most human decisions at Series B. But Series B then becomes a bit harder, because even if you outperform human decisions, given the fact that this top K, whatever that K means, is fairly humanly obvious. You only have to look at Sequoia done it, but then the access becomes impossible. And this is how also kind of these myths around access propagated around the entire venture. So people don't make much difference how hard it is to enter in a good pre-seed round versus a good Series B round.
Plus, we also got to all remember that any LP is in the asset class for the alpha, the outlier returns, and you don't create that by being non-contrarian and right. You got to be contrarian and right. So picking the most obvious two dimensions on which you wanna invest in, then deploy that strategy. Yes, you're maybe going to make a solid 3x if you're able to get access, but probably not more than that.
Yeah, I know for sure. And it's like, the more obvious they become, the more the valuation jumps up in those later stages. So it even changes. If you think about Quant VC, and there are a couple of firms that are doing quite a good job at Series B, and especially like I think Quantum Light, from what we know, are doing quite a good job there. But then the issue is not necessarily on picking the right ones. It's more in terms of the right valuation and the right access, which at pre-seed is very, very differently, because no one actually can understand what the right ones are. You have a subset of very, very good pedigree founders, but I would argue they are not even pre-seed, because generally everyone jumps on them, wants to give them money because they perceive it as less risk. But then the valuations jump to seed, Series A level anyway. So they're not, it's just a labeling, but they're not fully part of the asset class in terms of their risk return profile.
Yeah, in terms of the It's not really a pre-seed company.
It's not
despite
really.
you leading their first round.
No, and those ones we're completely not interested in. So on our job is not logo hunting. It's quite done in VC hunting logo to basically raise your brand. Our job is pure DPI machine.
Yeah. So then tell me, if you should give me 3 consistently strong signals that stand out, what are those?
3 things that stand out is the outlier trajectory of the founder, how we call it, like mapping out how a founder gets outlier trajectory. Another very, very good signal that we see on our side is a time series evolution on some parts of their graph, basically. So how that picks up. It's almost like a proxy of VCs haven't yet invested in their companies, but you can understand from a graph database and how their evolution through their graph database goes, what type of access, and almost predict what types of VCs will invest in the round, and you can use that in the decision. Third one, I think there are some statistics that we do at the market level. We look at markets very differently than other people. We look at these abstract competitive spaces where we run a lot of statistics inspired from like proper quant finance, from biology, and this statistical description of the spaces, again, in a time series way, gives us quite a lot.
How about Guy? I know you're a bit of a teams guy. You're not the mathematician talking nonstop. Tell me a bit about how you think about teams and the importance of team completeness.
So again, we look very sort of strongly at the founder experience, right? The founders data. Again, there's kind of the truisms that we hear in venture around 2 founders are good, 1 founder's bad. Where do you put 3 founders on that list? And so the approach that we took was very different, right? We're looking for the skills and experience and the relevancy of that experience of what the founders have done, but very, very kind of importantly to what they're doing now is a big part of it too. So again, if you look at how a kind of traditional VC or a human would do this at the moment, they would look at how a human or a traditional VC would do it. They would look at a CV or a LinkedIn profile that spent kind of 20 seconds skimming through it very quickly, and the over association with brands or experiences that they know, right? So, okay, Harvard is good, Stanford is good, Google is good, but it's very top level. It's very, very rudimentary. Again, with the power of the deep learning models, you can analyze, thousands, hundreds of thousands of people profiles. You can analyze them in a comparative way, and you can start to understand the sort of the level 2, level 3 qualities of experience, right? So it's, VCs all look for Stanford or Harvard, but with a deep learning model, you can say, okay, maybe it was someone that was at this Series B company at this very specific time in this specific role, who then went to this other company and met this person, and they had these connections that allowed for the experience, the completeness of the team to be good. And actually, it can be better for an unknown team because they have all the right ingredients versus 2 repeat founders who are raising a pre-seed at a 30 million post. And again, when you start to kind of bring the portfolio and the valuation into the decision, right, that's when you can start to uncover these much bigger upside opportunities. So whilst a team profile or a company profile may look less traditional or less obvious, the impact that it can have to your portfolio and your metrics can be way bigger.
Yeah, and Andreas, also, like, obviously our algorithms look, when we predict across any company, a part within the algo, and this is why I said it's going to get geeky, I'm trying to keep it understandable, is actually predicting first what the ideal team is for that in terms of the actual skills, in terms of the experience set of the connection, then analyzing each of the person on the team individually, analyzing them together as a team and overlap, and then understanding the delta between the ideal and there is, and then comparing those deltas to 20,000 other deltas of companies that are already labeled success and failures, to extract if that delta is meaningful enough and is more associated with the success distribution or the fail distribution. So it's all about a lot of depth into understanding all these details.
Listen, we've been speaking to companies since the beginning of 2024 that the algorithm has found. We run some kind of sample portfolios last year. This year we've been deploying capital. Must have spoken to 150 founding teams by this point. And what continues to amaze me is the the quality of the founding teams that the models are picking out right there. Deep subject matter expertise. They haven't necessarily come from tier, or what's kind of considered a tier one company or a tier one educational institute, but the variety of problems that the founders we've met are trying to solve, the consistent fact that we see is that the founding teams are always top quality, right? You would struggle, you struggle to find people that would know that space better.
Let me ask you, because you mentioned LPs and potentially opening up this tool for your LPs for them to use it on their own investment strategies and so on. Could you talk a bit about that?
Yeah, I think listen, what we've seen in venture again historically is it's the value exchange between GP and LP tends to be
not only DPI.
Not only DPI, right? So it's give me some money, I'll charge you a fee, and in 12 years I will do my best to give you more. Listen, what we have heard kind of as a consistent message is that LPs want to be more quantifiable in the way they look at the managers, of both the ones that are looking for funding, but also the ones that are already in the portfolio. Right? How can I get a second opinion or a different opinion on the metrics that I'm being given from my managers?
If we should just expand on this a little bit for the audience that might be tech founders and for that reason does not know the GP-LP dynamics super well, an LP will typically have VC be a very small part of their portfolio, which means that, yes, they want returns, but if you can use that investment to also make your other investments in the private space that is typically much larger, better, that would be very, very interesting. And at the same time, they also know that they need to hedge each investment into a fund with other fund investments because, as we started out talking about the power law distribution in venture means that you should not just put all your money with one manager. And for that reason, it's also very interesting if you're then able to, by investing in one manager, get a tool that allow you to pick other managers or diligence the managers that you're already working with. And at the same time, a lot of LPs, despite them not really being very good at executing on it, they also want very much to co-invest or follow on in the investments of their managers. And for that reason, it's also very interesting to get better at picking that.
Yeah, absolutely. I mean, you're so right. And from our side, exactly as we said, with the technology that we have has to serve the growth of the business and basically building trust with the LPs that support us through our journey, because we have to admit we're the first ones that are really doing that pre-seed. So our LPs have to be quite forward looking. I need to give it enough time to get into details and understand it. But for that, basically offering support across those areas that you mentioned is for us makes a lot of sense and strengthens the relationship with the LPs that we're having on board.
Yeah, it's a very typical value add or something that you as an LP would look at with a fund manager is, yes, can they give me returns, but what strategic value can I get out of them as well? Tell me, have you done it already with any LPs? And here I'm, of course, a bit knowledgeable because I know that you ran with Isomer Capital when they were talking to you. You ran a test on their portfolio, and it turned out to be absolutely correct on everything.
Look, we run it obviously with Isomer and with a couple of other small LPs as a demo, because the reality is it's almost like a byproduct of what we did so far. So the data that we can extract from it right now, although it proves to be very valuable, and the feedback that we got was quite mind-blowing on our side, the product is not at this point set up to do it consistently and at scale. The plan is that in the first couple of months of January, of the new year, so January and February, we're gonna double down on making a very, very solid product there that aims to not only give statistics and expected outputs of managers and so on, but actually dive very, very deep into their biases, into comparing their thesis with what they can do and predicting across all those data points, and giving LPs really deep insights that allow them to pick better managers. It's about untangling skill from luck in a sense.
Also, maybe an explainer to people that don't entirely understand how venture fundraising works. And I'll let you answer the question here, because now everyone has heard you go on about how amazing the tool is, how you can spot the best founders before anyone else and with more certainty than anyone else. So why the hell are you not a 500 million euro fund?
It all goes a trust. We just started, and in the end, look, and we understand it really well. The ecosystem works in a way. I think we're the only fund in the world that actually raised from institutions like Isomer Capital anchored us. As you said, we have participation from multiple capital. There's more funds that are probably going to join the round next to some families that never had an investment before, not even an angel investment, and that was quite on purpose. We are not the investors. We created this entity that can take the decision that obviously we need to support the entity. And in that context, people are used to basically looking at very different stuff like track record, for example. Even though mathematically, it just doesn't matter, especially if you have 30 investments, it's completely statistically non-significant, but it's a proxy. It's the proxy that LPs can actually use at this point. Until that process changes and until we get in market and prove that those stats hold more than the back testings and all the testings we can do, I think it's like any classic curve. We get the early adopters and the people that can truly understand. And a big shout out here to Isomer, and especially Michael that got very geeky with it and deep into it. You need LPs to really consider something that's groundbreaking and that devoted the time, because also our model is extremely complex. That's why it's very, very hard to explain without sitting with someone an hour or two with Myros or pieces of paper. And until that education piece is done and until the results are also replicated in real life, you can't expect every LP in the world to just jump on it. But we're going to probably sit here in 2-3 years as being the only fund that run a purely algorithmic strategy on the early stage and actually has metrics. And at that point, we assume things are going to change a bit.
Listen, if you believe finance and the finance markets are efficient, then it's just a question of time, right? It's his first returns. No one's going to get fired for buying IBM. It's the same inventor, right? People have their portfolio managers, and listen, in many cases, it's many years before people know if they're right or wrong. So for us, it's about doing this first fund, deploying it, really well. We want to do 75 deals in the fund. We're already at 11, nearly 12, making sure those deals are top quality, and we're entering on good terms. And then in 2 years' time, as Damian said, when we start to see the co-investors that have come in, the graduation rates, the investors in the follow-on rounds, that starts to be the tangible proof points that we're looking for.
So we could not have anyone more data geeky to answer the long-standing debate in venture about portfolio construction. Should you be concentrated? Should you do follow-on rounds? This is something that always splits the waters. I have ended up saying, well, you can do venture in many ways. It all lends itself better to some teams than others. And as long as you're just very well aligned, everything around one strategy, it can be done in many ways. But let's hear, if you run a fully algorithmic model where all you do is invest, then how would you put together a portfolio?
So look, again, I agree with you here. In the end, there's not one single answer. It depends on many, many variables. But at the top level, if you stack back, and we don't look across like Sequoia and Andreessen and the large capital accumulators in their own bracket, basically. But if you look historically, there's two strategies that work consistently. One strategy is a wide portfolio strategy, like the Y Combinator, Seedcamp, Kima Ventures, so on and so forth. There, the mathematics are very, very simple. If you the more shots on goals you have, the more the probability of hitting a fund return increases. So basically, if you could index the entire market of the VC space, you would get quite good return. The closer you get to that, even on a random selection process, you're going to probably get better returns than most of the market. Now, on the other hand, there is the benchmark model, or the founders fund model, where you run a super concentrated portfolio, you really double down on your winners, you put your whole power and knowledge to actually make those few outcomes that you're investing in come to fruition. The biggest problem is with 80% of the market is a bit in the middle, because To be benchmark, you have to first create that, like everything in terms of the real differentiation of the network, the real brand power that drives better survivability, the real and so on. So you get this host of most funds here. The ones that you hear doing 30 to 40 deals, basically I consider that the value of that, because it just doesn't make sense strategically in any way. On the benchmark side, the argument is, I'm good, I know what I'm doing, and I'm going to devote all my time to help them. And I'm going to give them unfair capital at the beginning, even to the level where you have companies saying, look, I want to raise 2 million, but they go away with you giving them 6 million, right? So you're really doing it right. But when you kind of doing half-fast benchmark, well, apologies, there's no better way of doing it, where you neither double down on anything there, you don't have a wide enough portfolio, you're kind of in a valley of that. And yes, even a blind chicken can find food once in a while. So some of them, these funds are going to have one fund that returns really well. And we saw it lots of times, but very hard to replicate. Now on the venture side and on the quant side and what we're trying to achieve, we almost consider hygiene and that you should not play in the space if you don't give minimum 3x back to your LP. And I know it's a big statement because that's kind of correlates with the top 1% actually in venture, but that's the reality. The market supports it. So all our modeling from the decision to the portfolio, because everything is connected, they don't do dissipate decisions, are set in mind with having a 97.5% confidence. You can't get it higher. It's due to black swan events of, even in a worst case scenario, achieving at the minimum 3x. So we're not chasing a 40x fund and a 0.3x fund. It's about reducing the volatility of the asset class. And for that, regardless of how good your decision engine is, you should be north of, I think the minimum mathematically that we could figure on our side was 57 deals, but you should be north of that. And therefore we play in the 75 to 85 deals bracket with this fund to make sure that we're never gonna go below a certain limit and target it in the 6 to 8x bracket.
And where we, Andreas, where we see this in fund 2, maybe fund 3, right, is if we think the opportunity at pre-seed is somewhere between 150 and 200 deals across pre-seed in Europe and the US. And if we could consistently do that in yearly vintages, then you're seeing all the great early stage companies, you're getting amazing follow-on opportunities through the later stages. And that's how you're powering this, this much bigger venture capital fund.
Follow-ons or no follow-ons?
From this first return, no follow-ons. Follow-ons only make mathematical sense if you have a strategic reason. If you have a concentrated portfolio, you're almost obliged to do follow-ons, for example, and it makes a lot of sense. But why not and why they only work? Because it's simply, every investment has to be judged almost like in poker. Like, what is the expected value of each dollar in each investment? And they end up competing between stages, right? So mathematically, if you don't have that strategic reason, it never matters. Like, you should never do follow-ons because your expected value on those follow-ons would have always been better to put at the beginning, right? So no follow-ons, simple check size for one check strategy.
Yeah. Then you manage your follow-ons through future vehicles and different vehicles, right? That if you look what the private equity funds have done very well is they have multiple vehicles, so you can increase your position in a company, which, if you have more capital to deploy, it makes sense, but it's LPs that are taking part in different pots with different risk profiles and different return profiles.
Maybe just I know we have a bunch of managers screaming at their phones right now saying follow-ons make sense. I get more information as the company grows and I get closer with the founders. And what you said here, Damian, is of course absolutely true in the scenario where you don't get substantial extra information as you progress with the company.
100% true in all cases. Like, look, it's just a mathematics, because actually the way of doing it, and I'm very happy to share a very, very simple Excel for any non-geeky Excel that you can publish for the managers to play with it. It's just not even a question. It's super clear. Let's say you have a pot of money X, and you do, I don't know, 250K the first round, and then to keep your pro rata, if you map the average growth of valuations, you have to do 1 million in the other one and 3 million, so on and so forth. If you shovel your money up front, if you can, and this is what I'm calling a strategic reason, if you shovel your money up front, even in your winners, so even in the ones that you ended up follow-ons once you knew more, you're still going to have like more participation, if you more ownership, if you put all your money up front. So it's simply mathematical clarity there. I don't think there's, and I understand, I've heard a lot of confusion.
The point, if you can, right, I think why follow-ons have become very, very common, very popular is because of the capacity of the traditional venture fund, right? The operating model on the 2% management fee implies so many people can be employed, which means you can only look at so many deals, and that breaks, right? You can't do what algorithms can do, which is analyze tens of thousands of companies. A team of 3 people can analyze tens of companies.
Yeah, but it's not even only connected to that. So basically, what Andreas says is, like, I keep my reserve, and that's the general narrative that you hear from many managers, and that's what LP says. I'm saying, look, and it kind of makes sense. This is why it's so hard to combat, because it feels logically, but it's not mathematically logical at all. It's basically the narrative there is, look, I have conviction to put a 500K check at pre-seed or whatever the check is, but I don't have conviction to take the full round for 2.5 million or whatever, because I want to wait to understand more information. I'm going to double down on my winners. Even the way you say it, double down on winners, that sounds great. Sounds beautiful. But actually, instead of doubling down on your winners, if you get actual conviction up front, and this is what the benchmark truly gets, and the 30 to 40 deals don't. If you truly put all your money up front, then simply, then you apply dilution rates, and you apply here, you do very, very basic mathematics to see, okay, on average, how much will be the valuation on the next round. You're going to build 2 charts, and you're going to have more ownership if you put that money up front. Basically, that's the...
And then it's, of course, again, because there's the deal dynamic of that first round. Will the founders allow you to put that much money in and get...
Exactly. That's what I'm saying, strategic. So if you don't, and on our side, because we're doing from this fund, we're doing small check sizes, there's no forces. But if there's no strategic reason, and that was the caveat, and there are other strategic reasons. For example, sometimes you just have to signal the market that you didn't give up on that company. They might need money later stage that you have to provide as a lead investor, because they might need that bridging, right? So there are many reasons. But having a strategy in which you say, I just hold capital because I'm going to know more about my winners, that just doesn't make sense.
Gentlemen, we are up on the hour. I have a final question that I got to put to you before we close. So I hope you give me another 5 minutes. All of this falls if you're not able to access the investments, of course. And you said that in the beginning that it is a bit of a myth that access is a problem at the pre-seed stage, as long as you just go around specific types of investments that are very, and they also have very high valuations because everyone knows about them and all the best are competing. So those you don't want anyway, but let me just get your completely clear answer to the access problem.
The hypothesis we had going into this was access at the pre-seed stage for 99% of the companies isn't going to be a problem, and the 1% where you don't get access, you don't want to be in anyway because the price is so extreme that it breaks the pre-seed model. LPs for a long time have been educated by their managers that the biggest problem in venture is access, right? Because when everyone is competing on the same terms, right? The GPs, that the big sell to LPs is okay, but I've got this network, I've got these people working, I can get access to any deal. So the biggest challenge that we have to prove, and the sort of the number one question we get from LPs that we speak to is, your algorithms might find great companies, but can you access them? Listen, what we found so far, we've done, as I said, we've closed 11 deals in the past 5 months. There's one company that we couldn't get access to, that we were squeezed out of the round. It became a party round. It was one where the valuation spiked anyway, and it's one we were sort of on 2 minds about doing. So what we're finding in terms of feedback from the founders we invest in is that they're technical founders, right? The companies that are being formed now are technical startups. And when you speak to a CEO and a CTO about an algorithm finding them, they're very intrigued about how did it find them? What does it think? What does it say? We can now give kind of automated investment memos to founders that we're looking at, so they can see what the algorithm's saying. They think the algo fund is cool, right? they like the idea of a different type of VC. So it's early days. I think you need to judge it at the end of the deployment of the portfolio. But the signals are very, very promising, right, from the founders that we're talking to.
I think most of the rounds we did ended up being oversubscribed in the end. And a few, we put them together, we discovered them, we brought them to a wider VC market to help them get the lead, and they got there. So I think it's a testament for how founders perceive us.
It's amazing the conviction that other investors are now starting to take in our models, right? In some cases, we're pricing up our own rounds by being in them. So that's the next thing to start to think about.
Congrats on that, guys. I am so happy to see your success and have done this deep dive with you. I think it's incredibly cool. And I do think that there's no doubt that AI and algorithms and whatnot are coming for venture. And I think that it is correct to say that it is not going to be just by data enabling what we already do. It's probably going to be more substantial than that. Gentlemen, thank you so much.
Thank you very much.
Enjoyed it.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.